All right, we're going to talk elaborate a little bit more on some of these issues that I talked about, and these put this on Moodle so that you can go back and review it. And first of all, that this is chapter 2 in the kind of the order in which we're doing things. However, in the textbook that you have, either the hard copy or the e-text, is actually chapter 10. So I'm sorry for that confusion. If you have any questions at all about the issue of chapters, what you need to read ahead of time, please let me know. After this chapter, we'll be more or less back on track. There'll be consistency between the chapter and the order in which the chapters we're doing, and then the number of the chapter itself. So actually, in this chapter, what we're attempting to do here is to look at cost. And we've talked in terms of what are variable cost, what are fixed cost. I don't want to go back and belabor that issue too much, bore you more than I normally do. But the emphasis in this chapter is going to be more on mixed cost. Variable cost, for the most part, are going to be found mostly in direct materials and direct labor. And really, the emphasis of the chapter is analyzing overhead costs, the manufacturing overhead cost. Now, some of those costs, in simply looking at the ledger, is very clear that some of those costs are in fact fixed cost. And the examples I use, for example, depreciation, if you're using straight line depreciation, if you're looking at property taxes, insurance, that are costs that are being incurred for the factory, those don't vary with respect to time or amount. So by definition, those are fixed cost. Now, the costs themselves come from the ledger. And so as you analyze the balances in the ledger account, say over a month-by-month basis, you begin to see that some of them, in fact, change as a result of production. So the question is, we know that they're not fixed costs because fixed costs wouldn't change as a result of a change in activity. But are those costs, at least for right now that we're going to define as mixed cost, are they a pure variable cost, or are they a mixed cost, which has both a fixed and a variable component to it? So part of what we're going to do is to come up with a way of defining the amount. Whoops, I'm going in the wrong direction. Sorry about that. Okay. And so what we're going to do is come up with this formula here. This is the famous y-intercept formula that you guys learned back in high school algebra. And we're going to break these into pieces where we have the A being the fixed cost, okay, and that will be referred to as the intercept. B is the slope. That will be defined as the variable cost per unit. X will be the activity or the cost driver. And more importantly, when we get to regression analysis, it will be referred to as the independent variable. Y is my dependent, or in fact, the cost that's being predicted. And in fact, if I were to look in the ledger account, I would say, okay, in this month, here's the cost, and assuming I have some level of activity that I can likewise associate with that. And that's really one of the major challenges in doing this analysis. Do I have some sort of measure of activity that, number one, is associated with the cost? And that is, as the activity goes up, the cost goes up. As it goes down, the cost goes down. And therefore, I can talk about the independent variable, the axis, being that which causes the cost. And that issue of causation is important because it really gives me a sense of the right to do regression, the right to do high-low method. So we're going to kind of move on from that. Okay. So oftentimes the variable cost will be referred to as the slope. The intercept, in fact, you'll see that terminology a lot on the printouts that you would see from Excel and other statistical analysis. That's the point with a mixed cost where that line that you are predicting will intercept the y-axis of the graph. Okay, and the mixed cost is the so-called linear cost function that we're trying to determine. It sounds difficult, it sounds esoteric, but it's just simply that y equals a plus bx. And we're going to assume linearity, that within a certain relevant range, that costs act in a linear fashion. And in fact, most of them do. It's very unusual to find a cost that would be curvilinear. A pure variable cost always starts at the origin. So with zero activity, zero production, I will have zero variable cost. Kind of makes sense. Because, man, the variable cost, what we're talking about here is the total amount. As my activity increases, my total variable cost will increase. My total fixed cost does not change, as you'll notice here, regardless of the amount of hours that I use, the activity, whatever you want to call it. A mixed cost will look like this, and that is the line, the green line, this y equals a plus bx, which we're defining here, will have a y-intercept, okay, which is, by definition, the fixed cost. At that point, at zero activity, we still incur a certain amount of fixed cost, whatever that might be. But beyond that, as we increase some activity, whether it's CPU hours, machine hours, labor hours, whatever the case may be, this slope represents the variable cost. Okay. Okay. Now, without getting too far afield, one of the major assumptions we're going to make that within this relevant range of activity, that these estimations that we come up with for both fixed and variable and a mixed cost will remain constant. So we can talk about them within that so-called relevant range. Now, again, this issue of cause and effect. In production, in business, it's often more of a common sense association. The accountants, the engineers, the people on the production floor get together and they look at ledger cost and they ask the question, what causes this cost to increase? So it tends to be sort of a consensus opinion that if we look at this specific activity, that seems to have an impact on the cost. But the other important element of that is that while it might be nice to be able to associate that, is the company in fact capturing and measuring that cost? Because if they're not, it won't do you any good. The company has to be able to capture that so that they can use that in their cost estimation. So again, this idea of cause and effect. The important thing is correlation, as we'll see in regression, never proves causation. Correlation, in a sense, says, look, okay, what you assume to be causation, because there's a high correlation, that assumption is substantiated. All right, so let's move on here. Okay, we're going to look at these two things here. Okay, we'll talk about account analysis. I gave you an example of that on the board, where essentially all a company is going to do with account analysis is to take total cost and through some sort of consensus and through subjective judgment, take that cost and break it into a variable component and into a fixed component. Basically, for every cost that we're going to look at, everything that we've identified as a mixed cost, through a subjective appraisal that I'm going to take part of that. It could be expressed as dollars, it could be a percentage. Nonetheless, I'm going to put a certain amount into the variable column and to the fixed column. When I'm finished, I'll say, look, okay, here are my fixed costs. That's my A. So I'll have my total variable cost. Well, at that point, that's my total variable cost. I need then to divide that total variable cost by some activity. Generally, if you're going to use account analysis, it would probably be production. So if you have, let's say, $1 million of variable cost in a column, and if your production is 100,000 units, then we can say that the variable cost per unit is $10 per unit. Account analysis is relatively easy, but not particularly accurate. But if you're only dealing with a couple of data points, if that's all you have, then why not? It's fine. All right, now, quantitative analysis. What we're going to look at are two basic methods. One that you're going to have to be able to do, actually calculate, is the high-low method. Regression, on the other hand, will simply look at results, if you will, printouts, and be able to interpret that to create that y equals a plus bx formula. All right, I don't want to belabor this too much. It's not that it's not important, but it's not something that's I think that you need to worry too much about. All right. Generally, this means the dependent, I have it in my ledger. This means I'm capturing some sort of activity. Likewise, that we have the data. If the data is not there, that's not going to help us any good. So you plot it, you create a spreadsheet, and then you begin to crunch the numbers. Now, the high-low method, as I illustrated, is relatively simple to use. And, okay, so what you're going to do is look at the data. It could be, generally it's going to be in some sort of spreadsheet format where you're going to have the activity and you'll have the cost. And so what you're going to do here is to find the highest activity level and its associated cost. You'll find the lowest activity and its associated cost. And remember, I'm picking data points. I'm not picking the cost and activities independent of each other. So I find the high activity, the low activity, and its associated cost. So for example, they tell you that in this simple case, that they've chosen these for you. They say, okay, the highest activity is 100, the lowest activity is 80. And so associated with that one particular point on my graph, the total cost of 2,500, and at 80 is 2,100. So the formula is the change in cost over the change in activity. This defines the slope, okay, which we, see if I can spell this right, okay, this is my variable cost, okay. What I've defined by taking the 400, the difference between the cost and the difference in activities, the $20, that becomes my slope. That is my variable cost per activity. So I have one part of the equation. Now what I need to do is to go back and plug that into either of the points. I could take the high point, the low point, it really doesn't matter. You pick whichever one. You don't have to do both of them unless you really want to check your answers, okay? And you plug it in. And what you know is that at y equals, at the high point, 2,500. We're solving for A, that is the fixed cost. That's what we're trying to determine. The variable costs are simply 20 times 100, or 2,000. So playing around with the algebra, by definition, fixed costs are $500. So at this point, through the high-low method, I now have my formula. And the whole point of this is that in subsequent periods, assuming that things remain constant, as we'll see here, going into the next year, well, okay, if next year the activity is going to be 120, and further assuming that that stays within a relevant range, then the predicted cost would be 2,900, okay? That's the point, that's the whole reason that I'm doing this. Number one, to understand the elements of this cost as a mixed cost, what's variable, what's fixed, okay? And furthermore, as we'll see in subsequent chapter when we build a master budget, that once I come up with my predicted sales, those sales will dictate what my activities will be. That'll be machine hours, labor hours, indirect hours. There are a number of different activities that a company can take on. So depending on what those activities are, I can then predict, if you will, build my budget and say these are my estimated cost. Okay. So as you can see, for example, whoops, go back here. Okay, if I were to plot these data points, okay, on this, and this is never a bad idea, this represents my high activity, and notice that here's an activity, here's a cost. Okay, here's an activity, here's a cost, and so what the high-low method does is to draw a line. See if I can do it reasonably accurately. Yeah, sort of. Okay, well, maybe not. Okay, but that's what the high-low method does. If I did it more accurately, it would look better. But it just takes those two data points and says, look, okay, there's my point. Now, in this case, I would say, it's not a bad predictor because there are an equal number of points above and a relatively equal number of points below the line. Where you become a little suspicious of the high-low method is when, as you draw this line, sort of imaginary or real, you find almost all the data points either above or below. So it either tends to over-predict or unpredict cost. So this one is fairly close. So it's not necessarily a bad predictor. And so, for example, okay, this is kind of drawn a little bit nicer and neater than what I did originally. So taking the 6 and the 8, the blue line here represents the high-low method using that, okay? If for whatever reason they chose to use some other data points, then the line you could see, if we said, okay, we're going to go with 6 and 1 for whatever reason, then we would find that that would tend to over-predict the cost because it's going to come in with more fixed cost than it does with if I use the actual high-low. Now, keep in mind, whether it's high-low or whether it's regression, one of the issues you have to deal with is what happens when I have an outlier or a couple of outlier data points, such as if I'm looking at issues of labor cost and the company's on strike. Well, that's not normal operations, so it would not be improper to simply say we're going to throw that out because that doesn't represent our normal operations. Mathematically, you should not do that, but business tends to be much more pragmatic. As I said, you're betting millions of dollars, so you want to bet them on what would be considered realistic numbers. All right, now regression. Regression is sometimes called the line of best fit. And what regression does, it tends to, well, it doesn't tend to, it does, it minimizes what's called the square distances, okay, between the data points, okay? So it draws a line that minimizes, which is the definition of calculus, either maximize or minimize, the squares of these total distances. In other words, I can't draw a better line that will minimize that. And if I give it this right here, that the y equals 300, okay, regression will give me that intercept of 300.98, and likewise will give me the activity, the variable cost for $10.31. And there is no better fit. I can't do a better job of drawing a line than that. And as you'll see, yeah, okay, visually, I have a lot of numbers. I have sort of an equal number above and below. Not always, but that's kind of a general rule with regression. So, for example, I'm going to look at, looking at this. This is my activity, okay? And we're going to look at not this one, okay? This is done. We're going to look at, the only thing you're going to be responsible for would be simple regression. That is looking at one independent variable, one dependent variable. And so what we're going to focus in on here is this one independent variable of machine hours. And what impact do machine hours have on manufacturing labor costs? Now, again, from a causation point of view, it would seem kind of clear. Yeah, there seems to be a cause and effect relationship. The more machine hours you incur, the more you're indirect. Okay, again, indirect is important because this is coming from manufacturing overhead. So I could do, for example, the high-low method, and it looks like this would be my high point. I'm kind of visually scanning this, okay, and 48, okay, and this would be my low point, okay, and here would be the associated cost with that. So under high-low method, if I were doing that, I would take the 1456 minus 17,710 and divide it by the difference between, well, in this case, divided by 50, the difference between 96 and 46. Okay, so that would be the way that I would do the high-low method. That would give me my variable costs, plug it into one of the data points, and figure out what the fixed cost would be. Now, this is what you're going to see, perhaps on the exam, perhaps on the quizzes, homework, the intercept. Okay, the definition of the intercept is where that line, that regression line, intercepts the y-axis. That is by definition the fixed cost. So that y equals a plus bx, the 300.98 equals the a. The independent variable, okay, which is again going back to that kind of strict definition, that is the variable cost, the machine hours. So for every machine hour that I incur, my total cost increased by $10.31. So these are the numbers that you're going to use to build the y equals a plus bx formula. That's in a sense the important point of doing a regression, the part that you're going to need to know. The other thing you're going to need to know would be the r squared. Generally, the better number would be 1. The closer it is to 1, the better. There's not necessarily a right or wrong rule about what is the best r squared other than closer to 1 is better. In business, you would say we'd prefer to have an r squared a little bit higher than that, perhaps around 0.75, 0.8, particularly if we are trying to build, if we're, in a sense, making a significant investment. Now, in some cases, I may be limited in terms of the data that I have. Some of the data may not give me anything better than that. So as long as that's all I have, fine. Some bit of information is better than nothing in terms of building a budget. So again, I know this is a repeat of the slide, but again, here's my regression line. I can use that in the next period as long as the X, okay, the activity does not exceed the relevant range. Once I begin to exceed it, then no, all bets are off. All right. Again, is it more accurate? Perhaps. It depends on the amount of data that you have. It is the line of best fit. High-low method can distort depending on how those numbers fall out. So certainly in that sense, regression is a little bit better in being the line of best fit. The other element of regression that makes it perhaps a little bit better than high-low is that it measures the probability, and that is the chance that this thing could be wrong, which is an important element in discussion as you go forward. Okay, for our purposes in the class, we're going to confine it to simple regression. One independent variable, one dependent variable. In reality, yeah, you can include any number of independent variables. Sometimes people will try to do that, thinking that that's a better situation, but in fact, it makes it a little bit more difficult to do regression, the more independent variables that you include like that. The goodness of fit, okay, the strength of the relationship between the two variables, in a sense, that's measured by the R-squared, and that becomes an important criteria in determining if we're going to use it or not. All right, we're going to jump ahead here. Whoops. I thought I was. Okay, we're not going to worry so much about learning curve. Learning curve is an interesting thing, but I think at this point we're going to kind of skip that. Now, again, some of the issues of data. Data has to be there. It has to be measurable. The company has to be capturing it. And the more data that you can collect over a period of time, the better. The problem with business is often, as I said, they tend to redefine themselves. There tends to be a lot of consolidation, changes. So what you're measuring in one period may not be measuring what you're measuring in another period. So that often could be a very limiting factor in terms of both measuring a particular cost and an associated activity. And that's plays out a little bit in the question of, well, is high-low better than regression? Generally speaking, regression would be considered to be better, but not necessarily. If you have a very limited amount of data, regression is not always necessarily better. Again, the issue of extreme values, the outliers, okay, those are issues that oftentimes you have to have a ready answer for. But again, the idea in business is that you want to make something realistic. That is, the numbers that we're using need to be based on realistic numbers, what the company really does. Okay, that's pretty much it for the chapter. If you have any specific questions, let me know. I will put out some questions for you to take a look at that we'll discuss on Tuesday, looking at doing account analysis, doing a high-low method, and interpreting regression.